So now we turn to the consumer. So we had some data come out, and we want to look at year-over-year changes. We want to look at gross numbers, real numbers, because we really want to understand what's happening with the consumer. Just because consumption is just over 70% of U.S. GDP, it's going to be a huge component of, how quickly does the U.S. slow down, and realistically, like, things are slowing, but not at a pace that is going to show that, the Fed is done. And that's where we kind of want to blend what we talked about just before in segment 2 into what is happening within the underlying consumer. So U.S. retail sales increased 0.5% over the last year, the lowest growth rate since May 2020, and well below the historical average of 4.8%. After adjusting for inflation, the story is a bit worse. Real retail sales fell 4.2% over the last year, the sixth consecutive year-over-year decline. So one of the things that we're looking at it, and this is why when we talk about consumer pressure, so at this point, it's essentially saying that people are still spending more money, but they're getting less volume. And that's the crux of the problem when you look at that real adjustment, where you're still spending, you're still trying to keep up, but you're walking home with less and less stuff. And when my wife and I, we were talking about this before. She had gone food shopping after, bouncing around, and we did a big food shop, trip. And she looked and she said, look at this. Like, this can't feed a family of 5 anymore. Like, now you have to buy 2 of them. So that increases the volume, but it's at a much bigger price, because not one bag went up in price already, but you're getting less volume. So now you're buying 2. So the volume is still just getting back to or slightly above where it was, but the prices have now more than doubled, because not only has the price gone up, but now you're buying 2 of them. And that's why when you look at families, that's where you're getting, and not to say that the single or those that in relationships aren't getting pushed, but those that have families, that have children, that, the leeches that you have to feed on a daily basis, you have to account for them, and it's getting more and more expensive to maintain just the general normalcy that we've come to know and love. Not to say that it isn't changing, because it is. Now, the important distinction here is the real retail sales peaked 2 years ago, which is when real wages turn negative, when you look at some of the red bars in general. And that's one of the things that we wanted to talk about, because real wages have been negative for I think we're up to 25 months. We think that this is going to continue just based on the stickiness in inflation. And now you're starting to see wages roll over. To be clear, the Fed wants wages to roll over. They want spending to slow, because that's how they can get in front of some of this inflationary moves. So here, when prices started rising faster than workers' wages, purchases started losing ground. And that's what you're seeing in general with the real retail sales and the nominal retail sales, where you're seeing that pressure. And as that nominal continues to move up, you're seeing the increase in credit card debt. You're seeing the increase in spending on the credit side. But as rates go up, it's going to be at an eventual point where people are going to say, look, I can't afford 25% on a credit card. Like, that just makes it where you get this big pullback in terms of activity. Here's, I think, a good breakdown, because the retail sales show a shift in consumption month on month to online shopping and general merchandise and away from autos. And that's something that I think when you look at the auto side, you're going to continue to see some of those pivots. You're going to see some of those different adjustments. And that's something that is going to only get worse. Now, when you look at the adjusted sales, so again, one of the things that we want to look at, retail sales, April retail sales came in at 0.4 month on month versus the estimate of 0.8. So again, it was well below estimates. So there was an expectation of April. And one of the things that we had said was that March was essentially the peak, that from there, and again, the front end of March, because as we talked about, the back half of March continued to come under pressure. And we expected that to continue to move down, which is here where we continue to see these pressure points moving lower. So here, when you start now looking at some of the different levels, sales X autos came in at 0.4, which is right in line with estimates. Sales X autos and gas came in at 0.6 versus the estimate of 0.2. Control group, which came in much stronger, came in at 0.7 versus the estimate of 0.3. So it's not all or one. Like there's definitely spits and starts, and that's the problem with trying to nail down the consumer, because just when you think it's over, they start spending over here, but not on this side. And the question is, which one matters more for GDP? Which one is going to matter more? But net, they're still positive. Yes, some of them are below estimates, some of them better than estimates. None of this is causing the Fed to turn around and say, wow, the consumer is really starting to hurt. We need to pare back activity. We need to cut rates. We need to stop raising. Rates are going up. Like they need this to slow. They need this to move down, and that's how you really start to get in front of inflation. They've already gotten the lending slowing. They've already they're starting to bring down asset prices. They need this to crack, and as this cracks, everything else continues to come with it, especially on the housing front, which we'll talk more about in the later on in this segment. Looking at the retail sales in year over year as a percent change terms, gain in April was the slowest since May 2020. Trend in retail sales continues to soften with 6 month percent change down into negative territory as of April, though not yet clearly in that recessionary territory. But again, you can see the progression is negative. It's not that we're fully in recession. Oh my God, the consumer's gone away. They're hiding in a hobbit hole. No, they're just slowing. And our point is the pressure's mounting, and June through August is kind of that core frivolous buying, going a bit more extravagant with where you're eating, going on vacation. That's not going to appear the same way because, again, the pressures have been mounting. And that's when the tightness is really going to, I think, make itself the most known on a seasonal basis. So then when you look at credit card interest rates, the average interest rate on U.S. credit card balances has crossed above 20%, with data going back to 1994. That's the highest rate we've ever seen and is 5.5% above the rate from just a year ago. And then if you extrapolate that out into 1980, I think the last time we had the peak was 1984, and we have now taken out that peak as well. Credit card balances in the U.S. increased 17% over the last year, the biggest spike since the 2001 recession. So again, the balances are going up exponentially year on year as the rates are going up exponentially. So now you're paying over 20% on an APR level, and now there's 17% more money that you have to pay 21% on. So again, you're just seeing the compounding impact, which is why we see a lot of these pressure points. And it's not surprising to see after-tax wages and salaries growth by income group based on the aggregate consumer deposit data is shifting lower, with the higher incomes already in negative territory. And remember, those above $125,000, those are the consumers that are spending the most. Those are the ones that are going to be driving some of these sales and buying, which we don't see happening. Discretionary spending per household on Bank of America credit and debit cards as a percent change, 1 month, 6 month, you can see, again, things really rolling over, which is why we keep talking about these pressure points. And people are still spending on credit cards at the lower end. But again, it's just going into this bucket where people have to pay more and more interest on, which is why we see a lot of that damage going forward. Industrial production came in at 0.5% versus the estimate of flat. Manufacturing production came in at 1% versus 0.1%. So one of the things that we've talked about is that things aren't going to roll over in a straight line. It'll roll over, it'll kind of bounce around, it'll fall again. So again, the trend is still down, but it's not this dire setup. And that's what we keep trying to stress. Like, that's where it's different than 08. 08 rolled and then just fell off a cliff. This is a bit, again, it's a bit different. There's still a ton of liquidity in the market. There's still a ton of money like floating around, sloshing around. So again, you're going to see these spits and starts, but our whole point is the trend is lower. But looking at this, it's like, why is the Fed going to stop raising rates? Why is the Fed going to cut based on this kind of data? Even the retail sales data, even though it's negative, moving further negative, but it's not in a dire position. It's not in a point where There's panic in the streets. It's just moving in the direction they want, still slowly. Here's another problem. Manufacturing component within PPI jumped by 0.5% in April, largest increase since May 2022. Finished consumer goods portion of PPI saw a 3-month annualized change move down to 7.3% in April. But again, look at the gross number. We're going back to 1990. It's still at all-time highs. So PPI in some pieces are starting to turn back up. You're still not seeing any meaningful drop in some of these numbers, which again is going to keep the Fed on the putting their foot down and trying to put brakes on this inflationary push. Consumer sentiment around purchasing homes due to interest rates has weakened over the past handful of months, reversing what was a little bit of a bounce. But as we've said, nothing dies in a straight line. There's nothing affordable about housing right now, and people are going to continue to pull back. The recent rebound in the University of Michigan consumer sentiment around buying vehicles, houses, and large household durables was short-lived due to the sharp drop in May. And that's what we've said. It's like people can only get so depressed. Then they're like, all right, well, we feel a little bit better. And then they're like, oh, no, we're still depressed. So again, all of this is showing the pressure points that are going to continue on the spending side. And now when we look into some of the data points, huge drop in May, Empire Manufacturing Index down to negative 31.8 versus the estimate of negative 3.9. New orders sank to the lowest since January, but prices paid ticked higher. Prices paid ticked higher is inflationary. Again, economic slowdown, but yet inflation still stays. Average work week moved up, still contracting. But then when you look at the U.S. Business Leaders Survey, you see a rollover again, negative 16.8. Service business activity rolled over. Now it came to that 16.8 versus the estimate of negative 9.8. So almost double as bad as what was expected. Employment ticked higher along with prices paid, prices received, and capital spending. Prices paid, prices received. Again, none of that is deflationary. None of that is disinflation. It's actually going up again. That's a problem. Now, when you look at, and the other piece is business activity popped back into expansion, but again, it's going to bounce around. New orders steeply negative, coming in at negative 28. That was what we were expecting, but expected new orders improved a bit. And that makes a little bit of sense when you look at the previous, going back to 2013, we're still at the low end, but one of the things that we've talked about is people still need products in stores. So if you have new orders consistently negative, it'll stay negative. It's not going to be this huge surge, but people are still going to have to order a bit to kind of replenish. And those are things that are going to happen in general. U.S. Empire Manufacturing expected prices received moved a bit lower, but still at the high end going back to 2013. And then CapEx fell through a floor. And that, again, is going to show investment pressure points, which continues to play out as we've been highlighting. Philly, when we move to the Philly index came in at negative 10.4 versus the estimate of 20. New orders improved from negative 22.7 to negative 8.9. Prices inched higher along with delivery times, but remember, prices moved up. That is not deflationary. Shipments still contracting, but moved a touch higher. Employment moved lower into contraction. So again, you're just kind of bouncing around, but everything firmly in negative territory, which when you look at industrial production, ISM manufacturing, it all shows where that direction is, because typically Philly is a good kind of headwind. Now, it means that we'll get a bit of a bump. We saw that industrial production, as we talked about, a few slides ago, but you can see the trend is still in contraction. So then when we look at University of Michigan inflation expectations, 1 year eased from 4.6 to 4.5%, but the 5 to 10 year expectation rose. If people are finally starting to kind of grasp to the fact that inflation is not going anywhere, then that's going to depress sentiment. So sentiment came in at 57.7 versus the estimate of 63. Expectations sank to 53.4 versus estimates of 60.8. So again, because people are like, look, long term, my spending is going to be hit. And that's why it's like the problem is not just the 23 problem, but also a 24 problem. So then when you look at the Atlanta Fed wage growth tracker, non-smooth, you can see that it fell, still very high versus 2005, but it's starting to come down. So as this falls, and then you look at the monthly changes, huge monthly change, But again, you have to put that monthly change in perspective. It's still high going back to 2005. So there's still more work to do. This is still inflationary when you look at historics, but the rate of change is going to slow, which is things that they have to try to get in front of. Transition into serious delinquency, which is 90 plus days for auto loans, continues to rise. The transition into serious delinquency for credit cards continues to rise. And as that rate, because remember, the rates continue to spike up, as those rates continue to climb, this delinquency is only going to get worse and put more pressure on the market. Percent of balance 90 plus days delinquent by loan type. Credit cards starting to shift higher. When you look at auto loans starting to shift higher, student loans, that ends in August, and that is where we will likely see a bigger issue as well. Net percentage of domestic banks reducing the maximum size of auto loans is at the highest it's ever been. And again, it's just because banks are like, look, I'm not taking the risk on that car, and that's going to put more pressure as office vacancies continue to climb. And again, the New York just set a new record. I think vacancies was above 22%. And that can, again, the work from home. And this is the bigger issue because when you think about, rent, a lot of companies maintained their rent and they were paying even though it was half filled, a quarter filled. But as the leases come up, they're downsizing. So that just means that office vacancies are increasing and the ability to backfill that is being diminished, which is going to put more and more pressure on the commercial real estate side. Where do you make most of your grocery purchases? When you look at it, the super centers, retailers continue to climb. That's likely going to increase just because it's a cheaper option when you go to Walmart. Membership clubs, as you can see, continue to increase. Specialty stores kind of flat, but the large regional grocery stores, those chains are where you're going to see people leaving the larger grocery chains and going more to the super centers and what do you call? I just lost the number. The membership. So the membership side, but I was talking to our producer last week, and she said that even she's not seeing the same benefits of going to membership clubs, and that's the problem because all prices are coming down, and who can going up, and who can kind of keep their prices the lowest before they have to yield. And you're starting to see the membership clubs, they have to raise prices, and now so that's where people are kind of stuck, and that's the replacement side, because if you can't afford Whole Foods, you'll go to, by us, it's King Cullen, for anywhere else, it's Publix, or it's Stop and Shop, and then once that is a bit more expensive, then you go to Walmart, but once that's expensive, there's not much else out there, and that's where you start to just change your spending patterns. Which reason best explains why you don't eat healthier? It's expensive, and that expense is not going anywhere. Millennials, homeowners, renters, homeowners increased for millennials, and renters are starting to turn back up. Mortgage and liabilities for the consumer credit side. When you look at the underlying credit, the biggest overhang for people is still the mortgages, but with rates, a lot of these people locked in rates so low, they can afford their mortgages, but as the equity gets chipped away, it's like, okay, they can afford the mortgage, but they've actually lost equity in the home, so their ability to sell and move becomes impacted. New single-family homes as a share of all single-family home sales remains at highs. Can't move, won't move. The share of job seekers relocating for new positions is at a record low, and that comes back to the golden handcuffs. If you bought a home and now you want to move, you're going to have to pay the bank a sizable number because you're not going to get what you initially paid for the house. But it's still affordable to live there because you can afford the mortgage. And that's, again, how people are a bit stuck. U.S. commercial real estate prices turned down. Lots more pricing declines are yet to come. U.S. housing starts were down 22% over the last year. The 12th consecutive year-on-year decline tends to be a leading indicator for the economy. Recessionary signals continue to build. Now, when we look at new privately owned housing units under construction, units in buildings with 5 or more units is at a record high. New privately owned housing units under construction, single family, are down because if you're a builder, you're like, well, I'm going to have to rent this. So I'm going to try to increase the units, spread my cost that still remains elevated. Labor, input costs are still high. So it's like, well, my cost of building hasn't come down, but I have to spread this cost across more units because I can't charge the same, which is why those multi-units continue to come. But as they come to market, there's going to be a surge of volume. And as prices stay elevated for homes, people are going to have to downsize and not buy a home, but buy a condo, an apartment, and that's going to, again, have that volume, which will then take that pressure off. April housing starts came in at 2.2% versus the estimate of negative 1.4%. Building permits came in at negative 1.5%. So again, permits aren't there, but housing starts, there's still volume coming to market. There was a rebound in the builder sentiment with 6 months change rising to 17% relative to before pandemic. That is the strongest gain in a decade. So again, you're still seeing home builders are like, look, I'm still feeling good about this, but rates, the market should be telling you otherwise. And that's when you start looking at homeowners downsizing, splitting up, and DIYing more remodeling projects. Some context around the Home Depot results. The U.S. Remodeler Index survey was early to pick up softness in remodeling and signaling a bigger slowdown. And that's, again, Home Depot was kind of your gauge for where things are happening because people are shrinking their spending, and that's going to continue to impact the way the people are viewing homes. MBA Purchase Index, again, a key leading indicator. It's the lowest it's been since 2014. With the purchase side continuing to show you, again, that pressure to the downside. Now, when you look at April existing home sales came in at negative 3.4% versus the estimate of negative 3.2. Monthly supply went up to 2.9. Medium home prices came down slightly, 1.7% year on year to 388,800. But again, number of multifamily housing units under construction continued to climb in April, rising to the highest since October of 1973. So you're still getting supply on the multi-units as existing home sales falter and a lot of other pressure points continue. Housing starts still below 21 and 22, but still elevated. New privately owned housing unit starts year on year. Again, you're seeing some of these pressure points, which is why there's kind of the stalemate where prices are going to fall. The question is always how quickly. They've already fallen, but there's still way more to go. And as the consumer really starts to really ratchet back, that's when you'll see this really start to take a bigger impact, especially as permits are slowing. People are just kind of starting what they can. As the multifamily permits, millions advanced by 2 months, start to roll over. So again, the permits are slowing now on multifamily, but they're going to try to bring what they can to market. And that's where you're seeing a lot of these pushing and pull, which again, all leads to a downside move, which we continue to see and believe is going to happen and continue to happen, I should say, on the real estate side. So that's what we have for you for the rest of the U.S. In the next segment, we're going to go deeper into Europe and some of the issues that are happening there.